Hello there. Welcome back to the Chain Accounting. This video, we want to look at the preparation of the income statement, that is statement of comprehensive income. So we've got a question that we have here, which is question 2.2. It is for Kingston Traders. So I think the question reads that the information relates to the financial year ended 29 February 2020. Goods are sold at a profit markup of 40% on cost. And then on the required part, prepare the income statement, that is the statement of comprehensive income for the year ended 29 February 2020. Then on the information part, it reads information extracted from the pre-adjustment trial balance on 29 February 2020. So this is the information that we have. We're given a list of balances that we have there. So if you go down, you see that this is the information that we have, and try to go to the next page to see what information do we have there on the next page. So on the next page now, it's a continuation of the list of balances that we have. And then on information B, we have got additional information and adjustments that are going down from information 1 to information 9. Then we have to see that also our question ends here. That's where our question is going to end. So you are supposed to go through each and every additional information before you start to answer the question, so that you comprehend the adjustment which needs to be done. We go back now to our answer section and try to see what we have in terms of the answer section. So we've got an income statement that we have that is already prepared there, that we just need to fill in. So we've got 2.2.1, which reads an income statement of Kingston Traders for the end of 20 February 2020. So we've got some pre-entered figures there in terms of discount received. Also have discount allowed being pre-entered, and we have also stationary amount being pre-entered. So going down, let's just try to check if you have got any other figure that is pre-entered there. So if you go down, you'll see that those are the only figures that are pre-entered. And let's take note, our question is got 45 marks. So we go there at the beginning of our income statement. We see that we've got sales, so we're going to start by entering the figures for sales. So obviously we are going to the trial balance or the list of balances that you are given there, and then we check the figure for sales that is there. Then we can make any adjustments that can be needed to be done. So going to the question. You would see that we can start by looking for the figure for sales that we have in this list of balances. So if you go down, you would see that we've got the sales figure here, which is 950,000 here. So we've got 950,000, but remember, we should look for sales return or data allowances. They are going to reduce the figure for sales. So if you go down, you'll see that we've got data allowance here. So we're going to subtract again data allowance of 14,000 from the figure of 950,000. And then also, if we go to additional information again, we might have some adjustments again that are going to affect our sales. If you don't have, we just adjust what we have here in terms of sales minus our data allowance, and then we put the net figure in the income statement. Obviously, the working also is, we are also supposed to show it in the brackets. Then we go to additional information to see if you've got anything that is going to increase or decrease the sales figure. We are here. Additional information number 1, it reads, we are here. Reads cash sales of 18,200 on 29 February 2020 has not been recorded. So this means we have an additional cash sales of 18,200 which we are not recorded. So we need to record them under as an addition to the sales figure that we have there. So remember, whenever we have sales, it means it's also going to increase our cost of sales figure. So we are also going to calculate the cost price and then increase the cost of sales figure. So we calculate the cost price from the selling price figure that we are given here. So this figure that we are given represents the selling price. So we need to calculate the cost price, and then we adjust for cost of sales also. So we adjust that when we get there, which is the next calculation that we are going to make. So basically, we are saying 950,000 is the figure for sales, and we are going to add the 18,200 of additional cash sales, and then we subtract 14,000 for data allowance to get our net figure for sales. So we come here, we are saying in brackets, we have 950,000. We add our 18,200 for omitted cash sales, and then we subtract the data allowance balance, which is 14,000. Then the answer that we get out should come here, which is 954,200. Or this is the final figure that we have. Then for cost of sales again, so we are going to check the figure for cost of sales there in the list of balances. And we see that cost of sales, we are given it here. And it is 400,000 here. So we've got 400,000 as our cost of sales. Then we have an adjustment that is affecting cost of sales in the additional information that we need to revisit again. That is the first adjustment of our cash sales of 80,200. But we are saying this is our selling price. So we need to adjust other cost of sales using the cost price. But remember, when you say cost price plus markup, you're going to get your sale price. So basically, in terms of proportions, the cost price is always 100%. Then the markup depends on the question. So we go at the beginning of the question, that's where it will be stated. We go there, you'll see that at the beginning of the question, we are told that the information related to the financial year ended 29 February 2020, goods are sold at a profit markup of 40% of cost. So it means we're going to say 100% plus 40%. 40% represents the markup. So we go there, we say plus 40% will give us the selling price, which is our 140%. So the figure that we are being given there as our cash sales is selling price, so it's 18,200. So we are saying 140%, which is the selling price, is equal to 18,200. So 18,200. So the figure that we are looking for is 100%, which is the representation in terms of proportion of cost price. So we've got 100% here. So this is the figure that we are looking for. So calculating it now, remember what we don't have is 100%, it becomes the numerator. What we have is 140% becomes the denominator. Then we multiply by the given figure, which is 18,200 over 1. Then we do that, you see that we are going to say our 100 over 140 times 18,200. You see that we are going to get your amount of 13,000. So this is going to be the cost. So it's going to increase the cost of sales. So this is the cost of the goods that we sold. The cost of the goods that we sold. So they're going to increase the cost of sales. So you are going to add them to the cost of sales figure. Remember, we identified the cost of sales figure there, whereby we said it's here, and we are saying it's 400,000. So we're going to say 400,000 here plus 13,000 that we got there as our cost of sales that was omitted. So here we say in brackets 400,000 then we add our 13,000 and we get 413,000. So this is what we have. And then our cost of sales, remember, we say sales minus cost of sales to get our gross profit. So obviously our cost of sales has to be a negative figure, so that we subtract it from 954,200 to get our gross profit. And then the answer that we get is our gross profit. We are saying 541,200. So this is what we have. Then we go to other operating income. We can leave it blank. We are going to list the other operating incomes beneath, and then we add the total to come here. So what we are saying is we have a discount received as pre-entered, so we are not going to be worried about that. Then we look for other incomes in the question. So we go to the question and try to see. So we are search for other incomes. Remember, we have got, let's check here, we have got fee income here, which is 82,600. So remember, all the incomes and expenses, and all the figures that we put in the income statement, we don't have to take the figure as it is from the list of balances and put it in the income statement. We first of all have to go to extra information and adjustments and try to see if we've got any adjustment that is affecting that item. And if there's no item that is affecting that adjustment, we can take the figure as it is from the list of balances and put it in the income statement. But if there's an adjustment, we need to adjust it first, and then the net figure, you put it in the income statement. So in this case, we've got fee income, which is 82,600. We need to go to extra information to see what is the extra information saying about fee income. If we have got nothing, then we can take that figure. Then you see that item 2 is actually talking about fee income. It's saying fee income of 2,400 rands is still outstanding for the period. So what does it mean? Remember, whenever we have got an outstanding, it means it is an amount that belongs to the current period. So we have to add it to the figure that we are having in the list of balances. So an amount outstanding, an amount owing, it means the same thing. An accrual, it means the same thing. We need to add it. So the opposite is true. When I talk about prepayments now, we need to subtract it because there are amounts that doesn't belong to this period. So in this case, we add our 2,400 to the figure for fee income that we have there, which is 82,600. So we go there and include our fee income. There's our fee income here. So here it means we have got a fee income. Then in brackets, we can just show the working whereby we are saying the amount that we are given in the list of balances is 82,600. And then we are going to add your 2,400. And then if you add there, the figure that we are going to get there, it's 85,000. So from there now, we can also check if you've got any other income that is there. So if you come here, we check, we've got other balances that are on the next page that we need to check if we have got any other adjustment for that. We also have, let's just check, we have got rent income here. Remember, interest income, we are not going to include it under the income. We include it after the operating profit, whereby we're going to add our interest income. So we can leave interest income, we adjust later. Then we go to rent income. We check the amount that we have for rent income. We have got an amount of 39,000. So as we are saying, we need to go to the different information to see if we've got anything that is affecting our rent income, in adjustment of rent income. We go item by item again, trying to check anything that is affecting our rent income. But if you go to item number 8, rent was received for 13 months. So what does it mean? It means these 13 months that we are given, we know that we prepare our income statement for 12 months, which is on annual basis, which represents 12 months. But if now we receive the rent for 13 months, which means there's one extra month that doesn't belong to this period. So we need to remove it. That's an income that we received in advance. So we need to remove it. It's a prepayment of an income that we need to remove from the figure that we have, so that we are left with the rent income for the current period only, which represents 12 months. So what we are saying is the amount that we are having in the list of balances is for 13 months, which is, we refer to that amount, which is our rent income. Let's just try to see. It's here. It's an amount of 39,000. It represents 13 months. So what we are saying is we are now saying 39,000, 39,000, and then we divide by 13. And we see what we get. If we divide by 13, we are going to get the monthly rent that was received, but the amount that was supposed to be received monthly, or that was received monthly. So we are saying 39,000 divided by 13, and then you are going to get your 3,000. So it means every month rent received was 3,000. So that applies to the extra month that was received. So you need to subtract this 3,000 from 39,000 to get the net figure that belongs to that period. So we go there and just make that calculation under rent income. So we also have another income that we're including here, which is our rent income. And we are saying 39,000 to subtract your 3,000. And then you are going to get your 36,000. So this is what we have. Then we can also try to check if there's any other income that is there in the question again. So after rent income, we can go down again to checking if we have got any other balance that is representing an income, a rent income. So we check on the next page. Yes, we have put our rent income here. So we go down. Interest on fixed deposit is part of our interest income. So we're going to add it to interest income and we adjust it after our operating profit. We go down, check for another income. Discount received, remember, it was already pre-entered. We can leave it. And then we go down, see that we've exhausted all the incomes that we have. But also, before you leave the other income section, you also need to check for trading stock surplus. It's part of other incomes. So remember, on trading stock, we are either going to have trading stock surplus or we have trading stock deficit. So if it's trading stock surplus, it's supposed to come under other income. If it's trading stock deficit, it's supposed to go under under operating expenses. So what we are going to do now, we are going to calculate and see if there's a deficit or a surplus. If there's a surplus, we put it under other income. If it's a deficit, we'll adjust it later under operating expenses. So it's something that we have to check before leaving the other income section, because if you identify it when you are already down on operating profit, it's going to give you some problems in terms of adjusting that figure. So let's just try to check it. So we start by maybe trying to put down the formula that we use to calculate that trading stock surplus or deficit. We are going to say book value minus the physical stock count value. Obviously, the book value you'll be given it in the list of balances. It will be a list of balances, or in other questions, it will come as a trial balance. And then the physical stock count figure is the figure that will be given in the adjustment section, adjustments, transformation and adjustments. So we check with those figures, but the book value, if you have got any adjustments again in the transformation that is affecting our trading stock, we adjust it with the effect of our book value, so that we get the net value of our book value, and then we compare it to a physical stock count. So the answer that you get here, if it becomes a positive, it means it's a deficit, trading stock deficit. If it's a negative, it means it's a trading stock surplus. So you have to calculate it as book value, then minus physical stock count. So we do a search now. We go to the to check the book value. We go to the list of balances, and then we see that the figure that we have there for trading stock is 231,000. So we go back and try to see. So our book value, you've got 231,000. Let's just try to see. We have got our 231,000 representing our book value. But then we need to check its information if there's anything that is affecting our book value. The adjustments that affect our trading stock affect book value. They don't affect the physical stock count for our figure. So remember, we have some goods here, cash sales of 18,200, and we calculate the cost price, and it was 13,000. And these goods were sold, which means they moved out of the business. So they were moving out of the trading stock. So they were not recorded. So we need to subtract 13,000 from the figure for book value that we have there. Then we get the net book value. And then we compare it now with the physical stock count. And the physical stock count figure is trading stock 220. Physical stock count of stock review the following stock on hand. So you only take the figure for trading stock, which is 220,000. So we go there. So first, what we are supposed to do is to subtract that figure of goods that were sold but not recorded, with a cost price of 13,000. So you adjust with the cost price, because trading stock valuation will be on the basis of our cost price. So we subtract there, then we get the net figure. Then after getting the net figure, we now subtract the physical stock count figure that we identified there. We identified that is our 220,000. So we calculate it as such. You see that the answer that you are going to get there is going to be 2,000. And it's going to be a negative. And we say the negative represents a surplus. So this is what we have. So we can just verify the calculation by saying 231,000, and then you subtract your 13,000. Then the other that will get is 218,000. That is subtract from 220,000. You're going to get your 2,000. So 2,000 becomes the surplus, and it becomes a trading stock, a surplus, which is supposed to go under other income. So we go there. Well, here now we are saying trading stock. So you just show the working here whereby we are saying 231,000. 231,000. I first of all subtract the 13,000. Then you subtract the 212,000. Close brackets, and then the answer that will go to us 2,000. So you see that all the spaces are filled under operating income, which means we have exhausted all operating income that we have in the question. So now we can now add 830 plus 85,000 plus 36,000 plus 2,000 to get the total for other operating income here, which is now going to be 123,830. So this is what we have. Then we can now add the two gross profit plus other operating income. You get now your gross operating income here, which is supposed to come here. Now we are saying 541,200 plus 123,830. And then you get your answer as, let's just try to see what we get there. If you add the two, you are supposed to get your gross operating income is 665,030. Right. Then we go to our operating expenses. Remember, the total for operating expenses is supposed to come here. But we need to list all the operating expenses that we have in the question. We have already discount allowed and stationery being pre-entered here. So we can go down and go up there and try to check other expenses that are listed in the list of balances that we have. So we go down, we have got our, right, after our data allowing there, we've got salaries and wages. So salaries and wages can be the first expense that we can mention there. We have got it stated as salaries and wages 168,000. 168,000. So we also need to check additional information, anything that is affecting our salaries and wages. So we come here. So you go item by item, trying to check. You get item number 4. One employee, IQ, has been left out of the salaries journal in error. He has not yet been paid for February. The details of this salary are as follows. So the figure that we need to include is the figure for gross salary. We are not worried about the net salary. So you would see that this salary was left out, which means it was omitted. So we need to add it to the figure for salaries that we have in the list of balances to get the total for salaries and wages. So remember, when we say our gross salary minus our deductions, you get your net salary. So in this case, you are given gross salary, we are not given it, but we are given deductions and our net salary. Net salary is here, and the rest are deductions. So to get your gross salary, this is the figure that we need, which is a question mark there. We say net salary, take negative deductions, that aside, it becomes a positive plus deduction. So this is the formula that we're just going to use. So I'm going to say net salary, and then we add over the deductions to get the total for gross salary. So basically, we are saying 7,300 plus 2,200 plus 400 plus 100. So we calculate as such, we are going to see that the total that we are going to get is 10,000. And this 10,000, you add it to the figure that we have for gross salaries. So for salaries in the list of balance, which is 168,000. Because remember, that 10,000 was said it was left out. So we need to add it so that we get the total 168,000 plus 10,000. So go to the other section. So here we are saying wages. And you are saying 168,000 plus 10,000. And obviously you're going to get 178,000. And afterwards, the salaries will go again, check other additional information that we are given. We've got fee income, which is an income. We leave it to go to the next list that we are having. Interest income, again, is not part of expense, but we have got consumable stores. We have consumable stores. Remember, the consumable stores figure that we are given here represents consumable stores that was bought during the period. The figure that we want to include in the income statement is the figure for consumable stores that was used. So for us to find the figure that was used, we are going to say what was bought minus what was remaining at the end of the period. Then we get the part that was used, and that one becomes an expense that we have to put under operating expense. So basically, we bought 5,500. We got the additional information to see if we got anything that was left during the end of the year. We see here item 9, they are saying unused consumable stores and stock amounted to 500. So it means 500 was left, which means 500 was not used. So we subtracted from the figure that was bought to get the expense part of that consumable stores. So basically, we are saying 5,500 minus 500. That's the calculation that we are going to make. So we've got our consumable stores. Which is same 5,500 minus 500. Obviously, you are going to be left with 5,000. So this is the answer that we have. Then we go to the next. So after consumable stores, we have got our rent income, which is an income, we skip it. And then we go to interest on fixed deposit. Remember I said it's part of interest income. So we are going to search for another. Discount allowed is an expense, right? We've got discount allowed of 1,260. So we are supposed to include it there as our discount allowed. So the amount that we are having is, let's just check the correct figure there, which is 1,260. So let's just try to see there if we have got anything that is affecting our discount allowed. Go to additional information, we're going to see that there's nothing that is affecting our discount allowed. So we are going to take our 1,260 as it is and put it in under the operating expenses. So we come here. We are here, we are now saying discount allowed. And we are saying the figure that we have is 1,200. Okay, at discount allowed, we have it entered here, so we cannot enter it again. It's here 1,260. So it was pre-entered, so we can just leave it. Then we can look for another expense which is not discount allowed. So you have to check for that as you are answering that all the pre-entered figures you do not enter them twice. So we have got our discount receipts. We it's not part of our expenses. Then we've got telephone, 9,200. We also have our telephone, which is our 9,200. So we try to see again if we have got anything that is affecting our telephone. in the list of in the adjustment section. So that's the next step that we need to go and check. So if you check your telephone, you see that we've got nothing that is affecting our telephone. So you can just take 9,200 as it is, and we put it there. And we also have our stationery here. Our stationery, remember, it's pre-entered there. If you check in the beginning of our operating expenses in the other section, we've got stationery pre-entered, so we're going to leave it. And also, we have got insurance that we have here. So insurance is got an adjustment, so you can leave it. So you can just take our telephone and put it as 10,200 in the other section. So we are saying. So we've got our telephone. And we're having an amount of 9,200. Then we go back again. So our telephone 9,200. Then after that, we've got stationery. And you said it's 300. Then we've got insurance 16,800. Then we check the adjustment that we have for insurance. They are saying insurance includes the monthly payment up to 30 April. Up to 30 April. So it means our year is ending 29 February. And then this insurance is stretching to 30 April. So it means in between February and 29 February, 30 April, there are 2 months, which is March and the whole of April. So we've got our 2 months that are extra, that doesn't belong to this financial period. So we need to find these 2 months and then remove them because they do not belong to this period. So it means if you go back and try to see how it is phrased here, they are saying insurance includes a monthly payment up to 30 April. So it means we've got our 12 months that were paid, and then the extra 2 months again were paid. So to make 14 months. So we have now insurance is 16,800. So you have to divide by 14 so that we get the monthly one. So we say 16,800, and then we divide by 14. And let's calculate to see what we get. 16,800, and then we divide by 14. You're going to get your 1,200. So here we say 1,200. This is the monthly insurance. Then we have got 2 months that we need to remove here. So we say 1,200 times 2. And you're going to get you 2,400. So you're going to subtract 2,400 from the total of insurance, which you are given in the list of balance is 16,800. Because that one is a prepayment, 2,400. So we go there. We are now saying insurance. And then we have an amount of 16,800. And then you subtract your 2,400. And then the final answer that you get is 14,400. Then we can as well go and try to see any other expense after insurance. So after insurance, we've got bad debts, which is 1,300. We have got our bad debts, which is 1,300. So we can just try to see in terms of those bad debts, how we can adjust. So if you check there in the additional information, if you have got any other bad debts that are being mentioned there, we can just try to go down. We go to item 7. We are here on item 7, where they are saying, right, on item 7, they are saying bad debts of 700 rands must be written off the account of G. Serino. So what does it mean? It means we have an extra bad debt that is there of 700. So we are going to add this 700 to the figure for bad debts that we are given in the list of balances, which is, you can just maybe recheck the amount of bad debts, 1,300, and then we add our 700. Then we go to our answer section. So we have our bad debts. Which is 2,300 in brackets plus 700. And then we are going to get your total figure for 2,000. So this is what we have. Then we go again to see bad debts seems to be the last that we have in the list of balances. We can try to cross-check. You see that bad debts is the last item that we have. So having that down, we have got some expenses that would not be listed in the list of balance, like depreciation. So we check depreciation in additional information. The depreciation is stated in additional information. We cannot find it in the list of balances. So after we finished, we have to check for it on how it is calculated in some figures. In some questions, you'll be given as calculated figures. Like in this question, if you go to additional information number 5, depreciation of vehicles of 32,000 and equipment of 17,100. So basically, we are going to say 32,000 plus 17,100. And then we get the total depreciation for the year. So we go back there and we do as such, we say depreciation. Here we are saying depreciation. And then we are saying the figure that we have is 32,000 plus 17,100. And then we get a total for 49,100. So this is, so after this now, we are supposed to add all what we have for operating expenses. We finished the operating expenses. So we are going to, from 49,100 going up, we add them until you reach our 1,260 for discount allowed. So that get the total for operating expenses. So let's just try to add it as. So if you add correctly, you are going to get your 267,760. And then obviously this is, we are going to subtract this figure, put it in brackets from gross operating income. So we are saying 665,030 minus 267,760. So let's just try to calculate it, 665,030. And then we subtract your 267,760. And then we are going to get your 397,270. You are going to get your 397,270. So this is going to be your operating profit as described here. Then after operating profit, that's where you're going to have your interest income. So interest income, we go to the our list of balances and try to see what we have in terms of our interest income. But remember, we've got 900 that we have at the beginning here on this page, which is 900 interest income, and also have interest in fixed deposit. We are supposed to add the two, 900 plus 1,870, get the total for interest income. So we come here. So here, interest income in brackets, we are seeing 900 plus 1,870. And then the total that we are supposed to get is 2,770. And we are adding it to our operating profit to get a total of profit before interest expense, which is going to be 397,270 plus 2,770. And we get 40,000, 400,000, sorry, 400,040. So this is going to be profit before interest expense. Then interest expense, we go to the question to try to find out about interest expense But if you go to additional information, I believe we've got something that we are told. We are told on information 6. Remember, you have gone through this additional information before starting to answer the question. So we will be knowing that there's something that is mentioned about interest on loan. So here we are given it as calculated. They're telling us that interest on loan for the year amounted to 30,800 rand. So we just take the figure as it is, 30,800 is our interest on loan. So we come here. So we are saying interest expense. And then we are giving 30,800 and we are subtracting to get a net figure for net profit for the year now. We calculate correctly there, 400,040 minus 10,800. You're going to get your answer is 369,240. So this is the final figure that is going to represent your net profit for the year. So this is what we have, guys, according to this video on the preparation of the income statement. Let's subscribe and share. Let's share the link to our colleagues who are doing grade 10 accounting. Let's turn the notification button on so that when we upload videos, you get notified. As for this video, I'm out to meet again in the next video.